Hello, good day, good evening to Germany for those joining us in Germany. I'm Emily Westhofen, Executive Director of the German-American Business Council of Boston, and I'm delighted to see so many of you joining us here today for our program. I will be facilitating this program in between the speakers and also note a couple of our logistics. Please see that we are using the Q&A function to accept any questions that you may ask to the panelists and to the speakers. The chat is more to communicate if you want to send any messages, but in terms of any questions, please use the Q&A function. And we have a very full program today. As you can see, many speakers. We're delighted to have them all. So we will go right into our program, and without further ado, I would like to welcome Bodo Liesenfeld, who is the president of the GABC and a member of the board of directors here at Boston. So welcome, Bodo, and we'll start our program.
Thank you very much, Emily, and good afternoon, dear members, friends, and guests of the German-American Business Council in Boston. As the president of the GABC, it is my sincere pleasure to welcome you today. This is the third time we are partnering with the German-American Chamber of Commerce in New York and JP Morgan here in Boston on this very important event. However, this is the first time we're doing this virtually, and the last, hopefully, as well. Almost to the day a year ago, we met at JP Morgan's very impressive client center at Rose Wharf here in Boston to discuss the economic outlook for German companies in the US. If you recall, that outlook was extremely optimistic. Then 90% of companies surveyed expected their business to grow in the following year. And the word pandemic did not appear in last year's survey report. It is to be expected now. We all know how differently the health crisis has affected certain sectors of our economy, and it will be interesting to see how this is reflected in this year's forecast. I'm looking forward to hearing Andreas Glunz of KPMG Germany present the analysis of 2021 survey results, which will be immediately followed by a discussion with 3 executives from German subsidiaries here in New England and who represent very different industries. The question is, do they all face the same challenges? I do wholeheartedly thank already now Jaime Paris Boisvert, General Manager Northeast at Siemens Smart Infrastructure, Roland Wandeler, Chief Business Officer at MorphoSys, and Javeed Buch, Senior Vice President at Windmoeller Hoelscher, for making time today to share their and their company's perspectives with us. This is moderated by Bernhard Brinker of JP Morgan, who joins us from Germany. Good evening to you, Bernhard. And now, it is my great pleasure to introduce to you Dr. David Kelly, Chief Global Analysis Strategist, and Head of Global Marketing Insights Strategy Teams for JP Morgan Asset Management. David has written extensively on all aspects of the US economy. He's a frequent keynote speaker and guest on financial media outlets such as CNBC and Bloomberg. He will set the stage with us for an international outlook. And you know, David, forecasting is difficult, especially when it comes to the future. And thus, we are all excited to hear what you have to say. The stage is yours.
Well, thank you, Bodo, and thank you all for having me at this virtual conference. And I'm hoping that we'll be able to put my slides up on the screen here. I don't know if that's possible. But what I'd like to do is take the next 15 minutes or so to just outline how we see things in the environment in the United States for German companies. And I must admit that I'm taking a little bit of a liberty here because I really want to just mostly talk about the US outlook, the aspects of it which are most important to German companies apart from the economic outlook, the fiscal outlook, the tax outlook, do have a little bit to do, obviously, with the change in regime in the United States, with the new Biden administration. I think probably an era of closer cooperation between Europe and the United States. And then, of course, there's the issue of exchange rates, and I'll talk about that too. But for the most part, it's really, the story that I would tell for German companies operating in the United States is a story I would tell for any company operating in the United States. What kind of environment are we really looking at here? And so I'm going to take some time. I'm not going to use all the slides that I'm in front of you here because I only have 15 minutes. I want to make sure I talk about the most important things. But what I'd like to do is talk about the course of the pandemic in the United States and how we think it's going to wind down. I want to talk about fiscal policy under the new Biden administration. I want to talk about what this means in terms of our outlook for growth and jobs and profits and inflation. I want to talk a little bit about our global outlook, our outlook for the dollar, and also our outlook for monetary policy. Normally, I talk a lot about financial investments, the stock market and the bond market. I'm not going to talk about too much of that because I want to really make sure I get the economic backdrop right, although of course I'm happy to try and address questions on that. But if we move forward one page in this presentation here, what I would like to talk about first of all is where we are on the pandemic. So there is some good news in this page here. The blue line is the number of confirmed cases of coronavirus on a 7-day moving average. And the dark line is the number of people who've died from the disease on a 7-day moving average. Now, the number of people who've died is a very grim statistic right now. It's running over 22,000 people per week. So over 3,000 people per day are dying from COVID-19 in the United States right now. But we have seen the number of confirmed cases fall in recent weeks. We've also seen a decline in what's called the test positivity rate and the number of hospitalizations. And all that tells me that this is, the worst of the surge may be behind us. When we look at vaccination in the US, there was somewhat disappointing news today out of Johnson & Johnson in terms of the efficacy of their vaccine. But I don't want us to miss the picture, the important story here. The important story is that both Pfizer and Moderna have produced vaccines using mRNA technology, which are very effective and safe. And they have promised the United States government enough doses for 200 million Americans by the end of July. Now, there are only 330 million Americans all told. And we know that these vaccines have not been approved for children yet. So we're just talking about American adults. There are 260 million American adults, roughly. We know that only 70% of adults say they will take the vaccine right now. So that gets you down to 182 million. So we think that, by the middle of the summer, when those doses have arrived, everybody in America who wants the vaccine will have it. In addition, we believe that based on mortality rates so far, about 100 million Americans today have some immunity to COVID-19 just because they caught it. And that number is going to grow in the months ahead too. So we believe that by the end of March, 50% of Americans will have some immunity to COVID-19. And by the end of July, something like 80% of Americans will have some immunity to COVID-19. And as we vaccinate more people, I think as we develop vaccines which are proven safe and effective for children, and that affects people going back to school, I do think the pandemic will be dampened down later on this year. We are worried, of course, about variants, but it does seem that both the Pfizer and Moderna vaccines so far appear to be still protective, even if you have these variants. So overall, it's a very dark time right now in the pandemic, but we do think the pandemic will wind down over the summer. I think that's probably true in Europe also. I think we just have to do the numbers on the vaccine distribution and recognize that when we do inoculate most of the population, the pandemic should subside. Now, what does that mean for the economy? If we move forward a page or two, 2 pages forward here, good, one more page. So I'd like to talk a little bit about GDP growth. So the way this US recession has unfolded is very unusual because of the cause. What it was a plunge, a surge, a crawl, another surge, and then a normalization. So what I mean by that is GDP fell by 5% annualized, then 31.4% annualized. Now then it bounced by 33% in the third quarter and 4% in the fourth quarter. But if you look at the GDP line, it is still 2.5% down from where it was a year ago, still very far short of where the economy should be if we'd seen trend economic growth. So there's still a lot of weakness there. And in the first quarter of this year, we think that the economy will slow down to not much more than 1% GDP growth because of the renewed pandemic. But even if we did not have fiscal stimulus, I think we would see a significant pickup in economic growth over the next few quarters as the pandemic ends. And with fiscal stimulus, it's going to be even more. President Biden has proposed two fiscal stimulus, two plans. One is called a rescue plan, and the next is called a recovery plan. The rescue plan is $1.9 trillion overall. I believe they will have to send this through Congress using what is called the reconciliation process, which means you only need 51 votes to pass it in the US Senate. But I think most of it will get through. And so it's $1.9 trillion as proposed. Maybe it ends up at being $1.5 trillion. But the important thing for the economy is a lot of it's really near-term spending, enhanced unemployment benefits, one-time checks of $1,400, $350 billion to state and local governments, $160 billion to reopen schools, $170 billion for COVID, for vaccinations, testing and tracing. All this is a lot of money to pump into the economy in the first 9 months of this year. And so we think that by the end of this year, nominal GDP growth, which is real GDP plus inflation, could be up by as much as 10% year over year. And that should encompass about a 7 or 8% increase in real GDP and inflation of between 2 and 3%. So we think the economy will come back very strongly. It will also be strong early in 2022. And then, frankly, we will be approaching full employment. And as the economy will slow down again as that pent-up demand for services diminishes. And by the end of 2022, the US economy will look quite like it did at the end of 2018 or the end of 2019, a slow-growing, close to full employment economy. If you move to the next page here, in terms of employment, the unemployment rate right now is 6.7%. We expect that if we get this surge in economic growth, unemployment could come down to about 4.5% by the end of this year, which is an extraordinary pace of increase. So there's a lot of hardship right now. But as the economy reopens, as restaurants, hotels, the travel industry, entertainment industry, as they get going again, they are very big employers of workers. And we think that will bring the unemployment rate down below 5%. If you move forward one more page, on inflation, we got inflation numbers today on the PCE deflation, the core PCE deflator. We're still looking at a headline PCE or personal consumption expenditure inflation only running at about a little over 1%. However, by April of this year, that number will be over 2%, we believe, because of a very easy April last year, where we had prices fell very sharply a year ago. On a year-over-year basis, we'll have inflation at about 2% or a little bit above by this April. And we think that will continue and even accelerate by the end of the year just because there's so much demand. We will have people, consumers with a lot of money in their pockets, and they will want to eat out at restaurants, fly on planes, stay at hotels. The prices of all of these things will go up. So we think inflation will be over 2% by the end of the year, and could continue at over 2% into 2022. Turning to corporate profits on the next page here, we will see, we think, a good rebound in corporate profits next year. Corporate profits did fall in 2020, but we show in this chart here quarterly corporate profits on a year-over-year basis. If you average them together on a year-over-year basis, we do think that profits will only be down about between 20 and 22% for 2020. That's a lot smaller of a decline than we saw in 2008. And we think profits will hit a new all-time record high in 2021 because of a rebounding economy. Thereafter, profit growth will be slow. And I think it is possible that we will see a tax increase on corporate profits in 2022. That's a very close call. It depends on whether in the rescue bill, sorry, not the rescue bill, the recovery bill, which President Biden will talk about at the end of February, does he put tax increases in that? And does that pass the Senate with tax increases in it? I know he will spend more money on infrastructure, on green infrastructure in particular, but will he fund that with tax increases? We'll see in that bill later on this year. If we see an increase in taxes in 2022, I think corporate profits won't grow in 2022, and I think they'll grow much more slowly going forward anyway. We will have higher wages, we will have higher interest rates, we'll have slower economic growth. That will slow down profit growth. But in the near term, profit growth will be very strong. Turning to the rest of the world on the next page, this next page here is what we call our Pmi Heat Map. This is the composite purchasing manager index for each of these countries. Composite meaning services and manufacturing. Green is good, red is bad. You've got the developed countries up top, you've got emerging markets down below. You can see that the United States almost uniquely among the developed world and indeed the emerging market world saw a 10-year long expansion after the great financial crisis. But then we had all these countries go into pandemic recession. We know that North Asia, China, Korea, Taiwan, Japan, have all dealt with the pandemic much better than Europe or the United States. But in the end, that won't matter for economics by the end of this year. It does mean fewer people died in those countries, and it's a terrible death toll in Europe and the United States. But by the end of this year, I expect Europe and the United States will be vaccinated. And so the right-hand corner of this, or the right-hand side of this page, will look very green by the end of the year. We'll have a booming global economy at that point. Turning to the dollar on the next page, there is a strong relationship between US economic growth relative to the rest of the world and the dollar. When the US grows more strongly relative to the rest of the world, the dollar tends to go up. When the US grows more weakly, the dollar tends to come down. We have seen in the late 2010s, we saw very strong US growth relative to growth in Europe and the rest of the world, partly because of the Trump tax cuts. But we have seen I think we will see going forward, a slower US growth rate because the US does not have strong immigration anymore. Productivity growth will slow. China is still growing very quickly and is a bigger part of the global economy now. So I think the US will lose its lead relative to the rest of the world. I also believe that going forward, the United States will have a much more constructive approach towards tariffs. I don't think the US will fight a trade war on tariffs, but that does mean that if the US wants to improve its trade deficit, it will need a lower US dollar. And I think the US dollar will probably fall in the years ahead. And then finally, the last thing I want to say, if we move forward, three pages here, one more page and one more after this. Okay, great. Sorry, back one. I'd like to talk a little bit about the Federal Reserve. So the Federal Reserve had a meeting this week to talk about monetary policy. They didn't change anything they had said about monetary policy, but let's see where they are. They have adopted something called average inflation targeting. By average inflation targeting, they mean they want the inflation rate to be 2% on average. And if inflation has been running below 2%, they're willing to tolerate inflation of above 2% for some time. They have very specifically provided us with guidance as to what they will do. They have said that they will not raise the federal funds rate from its current range of 0 to 25 basis points until such time as they've achieved their goals of maximum employment and inflation at 2% and on track to exceed 2% for some time. Now, when the Federal Reserve has not said exactly what they mean by maximum employment, but if you listen to Jay Powell and Janet Yellen before him, we think that that means below 4%. Both the Federal Reserve in general believes if you have a very low unemployment rate, you can help the minority workers, poorer workers, those who are most hurt by the pandemic, and they want to get that unemployment rate below 4%. And so I think that even though unemployment will fall sharply during this year, it may well still be 2023 before you get that unemployment rate below 4%. And until that happens, we do not expect the Federal Reserve to raise the federal funds rate. However, they have also said that if they make substantial further progress towards those goals, they may begin to taper their purchases of bonds. Now, if you look in this table here, they expect that this year, real economic growth from the fourth quarter of last year to the fourth quarter of this year will be 4.2%. They expect an unemployment rate at the end of this year, the fourth quarter, of 5%, and an inflation rate of 1.8%. If the Biden rescue plan gets passed, we believe that change in real GDP will be greater than 4.2%. We believe the unemployment rate will be less than 5%, and we believe inflation will be above 1.8%. If that happens, we think the Federal Reserve will want to begin to taper bond purchases. But the Federal Reserve has made it clear, Jay Powell made it clear this week, that the Federal Reserve will give people plenty of notice of that. So right now, we think the Federal Reserve may start to talk about tapering bond purchases at the end of this year, but they won't actually begin to do it until March of next year. But even with that, if that's what happens, I think we will look at interest rates rising and the yield curve steepening. Because if they've committed to keep short rates low, but you have a booming global economy, you've got inflation moving above 2%, you've got real economic growth of above 5% and really closer to 10%, and you've got a lot of deficit spending by the federal government, we think all that means higher long-term interest rates. For investors, this is a difficult situation. I think that if you look at valuations for US equities, they are expensive. And indeed, also for US fixed income. That's true around the world. And therefore, I think investors will need to be more careful going forward. I think this is a time where in financial investments, you need to think about active management. You need to think about buying sectors that have which are less expensive, things like US value stocks, emerging market stocks, international equities. I think you've got to be careful of things like long-term US government bonds or US growth stocks, and particularly mega cap growth stocks. But the broad story is, I think, one of improvement and greater certainty. Last year was a year of very, very difficult year in terms of the economy, in terms of society, but it was also a very confusing year. It's like there was this thick fog surrounding all of us, and we didn't know our way forward. Going forward, I think the fog will clear, the climate will warm up, but as it does so, people will think more carefully about what it is that they own. And I think that will mean that some of the stocks that have done best and some of the sectors in financial markets that have done best will do more poorly, and other things that have been left behind, like international equities, emerging market equities, and US value stocks will do better. So those are the main points I wanted to make. I don't want to go any longer than that, but I'd love to leave it at that and then move on with the rest of your program.
Thank you very much, David. That was indeed very interesting, and it's going to be very interesting to hear too if later on in our program here today, if, for example, the rebound, the corporate profits you're expecting, if some of the representatives of our industries will concur with that. So that'd be quite interesting to see, and also if that's reflected in the survey results. So thank you very much for making time for our German-American business community here today, David. And with that, I would like to thank you and welcome at this time Dietmar Rieck, the President and CEO of the German-American Chamber of Commerce, New York, a position he's held since 2013. And it is actually thanks to him and his team that we can share this next part of the event with all of you. And Dietmar, I'm pretty sure that you are, we have to bring you back up on camera again. I think we lost you there. That you actually don't have to travel today in this wintry, very windy day here to Boston, as you've done in the years before. But of course, we do miss the in-person event, and hopefully we can return to that next year. So with that, Dietmar, I will hand it over to you for the next part of the program, and also then introducing our next speakers. Welcome, Dietmar. Thank you for making time and doing this for us again.
Thank you very much, Emily. And I would have loved to come to Boston. I have to be honest. No weather could prevent me from that. You know, quite a connection I have to the city. And thank you also, Bodo Liesenfeld, for having us today to cooperate again in presenting this result. Greetings to all of you. I think it's not too late. Still January. I wish you all a happy and healthy new year 2021. And to what David has said, yes, we got some news this morning with Johnson & Johnson and the vaccine. I take it actually quite positive, because the thing I have heard in between is, you know, if you look at severe disease or even death, unfortunately, it seems to be very effective and efficient. So we take that as a positive news, and it's a different technology bringing us forward. So looking forward to a good year. Being in the German-American business, I also want to mention that, you know, that great cooperation across the Atlantic can yield fantastic results. And the first vaccine, which actually came out on November 9th when it was announced, was, to my knowledge, a cooperation between a German company, BioNTech, one of the leaders in the mRNA technology, cooperating with Pfizer, the American or New York-based Pfizer companies, and they have been indeed the first one to the finish line to provide us with this long-awaited vaccine. I think that's a wonderful was a wonderful event, and hopefully, and I liked what I heard from my prior speaker, that very soon we seem to be through this thing. We can't wait, that's for sure too. Speaking about cooperation, I'm also happy that we have had this wonderful cooperation with KPMG now for the fourth year in providing the German-American Business Outlook. It's actually the 12th year we are making or providing and putting these data together for the German, or GABO as we call it, these results. So we have some time series going back quite some time, and mostly it has been positive, and I don't want to take anything away from Andreas and his presentation later on. But we hope that the GABO, this report, really is a valuable information for you to see where the business community stands, what are the most important points at any given of time, how the sentiment is going forward. We also hope that it could be a basis for decision making on individual companies, that they see, and listen, this is what happened on other companies and so forth, and can take it from that way. And lastly, or thirdly, for us as an association, it should also, and has served for us actually, as a guideline to where we put our focus, for example, in dual education, in these kind of areas that has been in the past. None of that would be possible without you as the companies taking some time, filling out this questionnaire, completing the questionnaire, and sending it back to us. A heartfelt thank you to all of those companies, and to you as the executives who have done that. And we will continue with it. So please do it again next year when we come ask for help in our questionnaire, and hopefully you use this report as well. And now it's my pleasure to introduce Andreas Glunz to you, our partner. Andreas, for quite some time now, as I said, with KPMG, I think our report, no self-praise, is getting more and more content in it, and it's a 40-page document. At this point of time, it would not have been possible if we wouldn't cooperate with you, with your colleagues, and actually my colleagues as well. And to quickly introduce Andreas. Andreas is a partner at KPMG Deutschland since 2000. Since 2015, he's actually the managing partner for all international business out of Germany. And as it is, if you work for KPMG, it's certainly good if you are CPA, Wirtschaftsprüfer, and Steuerberater certified. So again, it was a pleasure working with you on this one. And the floor, or the monitor, is yours. Thank you all, and all the best.
Yeah, thank you very much, Dietmar, and warm welcome from my side. So it's a big pleasure continuing the tradition, Dietmar, that we have started some years ago, and I think it's always very good insights that are being provided. And also from my side, a big thank you to all of you for the close and good collaboration, which we are intending to continue, of course. and for all the participants in the survey who responded to us and answered all those questions. So thank you very much for that. What I would like to do today is to share with you the results of the survey that we've undertaken in the end of November. The slides can already be seen. So we have undertaken that survey actually after the US elections, since we felt it is important to wait until the results are clear, so that because all of that will surely impact also the business environment in which the German companies are acting in the US. And if we move to the first page, then this is briefly showing to you how many companies have been participating in that survey. So the number is roughly 170 companies that participated. It's more or less similar to last year. On the next page, you can see that the setup of the companies that participated is comprising a lot of different industries, and it's a fair representation of German companies in the US. It also shows that a lot of those entities are invested in the US already since a long period of time, 17%, even more than 50 years. And on the other hand, you can also see that there are also 1 out of 10 companies who just started off their businesses in the US during the last couple of years. So there's a constant flow of new investments into the US. So the survey on the next page comprises, or the study comprises basically 2 parts. It's a research part, it's a survey part. So Dietmar said correctly, it is more than 40 pages, fully packed of content. So you may also have a chance to read it in detail if you access it via our homepage. So if you have a look at KPMG, then it can see directly. It is, of course, also on the website of the chambers. And I would like to very briefly show some of the interesting facts and figures, and then the results of the survey itself. And the next page already summarizes the main findings that we have seen. And I don't want to dive into the details now because it is shown on the subsequent slides that I'm showing to you. It is only showing to you the content of the survey. So we were asking about the business development in 2020. So specifically also, how did COVID impact the business? And then secondly, we were asking about future expectations in 2021 and also the actions that are being taken. Since we were faced with the COVID situation and with the elections in the US, we also choose to include specific questions on those 2 topics about which I will also report about. So let's then move to 2 slides that are explaining a little bit about the environment in which German companies are acting in the US, and which is meant to set the scene for this presentation. So what you can see there is that, and you're probably aware about that, US and Germany are 2 of the biggest economies in the world. So that's not very surprising. Apart from China this year, all other industrialized countries were facing a decrease of the GDP. So it's the US was -4%, it's Germany was -6%, but it's China was +2%. So the gap obviously between China and the US is closing time by time. And on the right-hand side, you can see that the trade between Germany and the US is stable. It's even increasing over time by time. And Germany and the US are linked up very much. And it is also, if you combine it, it's a really big trade volume within that corridor. The next slide shows a little bit about the foreign direct investment environment. So how many foreign direct investments are being taken? And on the left-hand side, this is from a US perspective, and on the right-hand side, you can see it from a German perspective. So from a US perspective, And that is quite impressive from my perspective. Germany actually is the #3 investor in the US. So it invested more than $522 trillion of money in the US, and with nearly 12% holds a big share in the overall FDI in the US. On the other hand, from a German perspective, US is the most attractive market to be, so it is the #1 destination by far. So we've seen that recently in 2020, FDI of German companies in China has raised, actually also exceeded investments in the US, but there's still a long way to go. So it's ×3, so the number of German entities in the US. And also the sales volume that you can see here is really impressive for German companies that they are generating from the US. But I will show about that a little bit later also from our survey. So then let's move to the survey results. I guess this is most interesting for you, and everyone is interested in what German companies feel about their investments in the US. So the first key observation is related to the business situation in 2020 for the US entities. And what can be seen here is what may be surprising, or at least it would have surprised during the year, maybe not at the end of the year, since there is that bounce back of the industries. So it is just I think you have to go one page back, please. So it is just 10% of the companies, of the German companies, that were generating losses in the US this year. And that's quite stable as compared with prior year, in which it was 7%. So 90% of the companies, of the German companies in the US, obviously generated profits. And if we have a look at the different levels of profits that are being generated, then you can see in the top layer that nearly 1/4 of all German companies in the US are generating more than 10% profits in comparison with net sales. So that is a very, very sizable profit margin that is being generated. And apart from that, it is also quite constant as compared with prior years. So if we have a look on the next page then, which you've already seen for a moment, this is the group's perspective. So from the view of the German headquarter, so what is the contribution of the US entities to their overall global consolidated net sales first? And then the slide afterwards, I will also explain about the profit situation. What you can see here is that the US entities of German groups are contributing significantly to the overall net sales level of the group. So 15% of the companies told us that they were generating more than 50% of their overall global consolidated group net sales from the US. So that is really impressive. Although as you can see, it decreased from prior year, from 21 to 15%, and the layer of between 5 and 10% increased quite considerably. It is still a very profitable business situation and a very, very sizable net sales volumes that's generated in the US. We are currently also finalizing our survey with German companies in China. And because of that, I can also share with you comparable results, what German companies are telling us about China. So in the top layer, it is actually just 4% of the German companies that are generating more than 50% of their net sales in China. So the US obviously is much more important, even in this year of COVID, than the China market. And on the next slide, you can see that also from a profits perspective. And the picture, I would say, is quite similar. So you can once again see that the US entities contribute significantly to the overall group profits that are being generated. But once again, we can see here too that the profits are decreasing and that is probably due to the COVID situation. So you can see that it's decreasing from 20 to just 9%, and the layer of between 5 and 10% of profit margin has nearly doubled. Once again, comparing that with the situation in China, so it is 5% of the German entities in China who are telling us that they're contributing to more than 50% of the profit. So also there, it's just half of what the US entities are contributing. I think that is quite impressive and interesting to see and understand. Then on the next slide, I would like to show to you what the respondents are telling us about their future expectations. And as Dietmar explained beforehand, so we have a long tradition of surveying German entities in the US. That is why we can show up a long-lasting scale here of years, so we can compare it with each other. So what we see here is, first of all, that it is just 8% of the companies that are reporting to us that they are not expecting growing of the business. So it's 92% who are expecting a growth of the business. And those that are expecting strong growth are more than 1/3. So you can see that the percentage is over time decreasing. So since 2016, that share is decreasing, but it is still remaining on a high level. So you might be surprised that the expectations in 2019 for 2020 were so positive, but that is obviously because we asked those questions before the pandemic approached and broke out. So all in all, I think that is a very positive sentiment of the German entities that can be seen here in the market as regards their own businesses. If we have a look on the next slide, how they assess the US economy as a whole, then once again, we can see a quite similar picture, where, however, the expectation of strong growth is smaller, is less than it is expected for their own US businesses. But all in all, the situation, once again, is the same, and the contraction of the business in the US economy is just expected from very few of the respondents. On the next page, we were also asking what are the main challenges that we were facing in 2020 and for 2021. And it is not surprising to see that the number one topic here is COVID-19. So all in all, with a response rate of 65%. Later on, as I said, we also had some specific questions on COVID. I will also briefly explain about the reactions of German entities, how they were considering, which steps they were considering in order to overcome the situation, the difficult situation. But apart from the COVID-19, it is once again the availability of skilled workforce in the US market, which proves to be very burdensome and difficult for German companies. So last year, the response rate on this one as a challenge was 56%. This year, it's 45%. So it still remained as the number two big topic. And if you put that into context of what is on the next slide, which is that German companies are intending to grow their business even further and are expecting to grow their workforce, which you can see on the next slide, please. Then, of course, the availability of skilled workforce becomes an even bigger problem for German companies in the US market. So here we were asking, what are your expectations, how the number of employees will change, and that on the short term in the next business year, as well as on the longer term within the next 5 years? And I would say the result is quite clear. So it is just 5% who are telling us that they are intending to decrease the workforce, either short-term or long-term. On the other hand, it is more than 40% who are intending to increase it in the next year. And this is even more than 70%. So it's 79%. We're expecting to build up the workforce within the next 5 years, 30%, even by more than 25%. So this is a really strong increase of the workforce that is being expected. later on we will see that this is also mirrored in the investments that are being intended by German companies. So in that context, it must also be seen on the next slide that German companies are facing also difficulties in recruiting. So it's not just working visa topics, but it's also difficulties in recruiting in general. And that despite of the record unemployment that could be seen in 2020 due to the COVID situation. So only 14% of the companies are telling us that they never experience any difficulties in attracting skilled workers, but that is 64% who are experiencing some or great difficulties in attracting skilled workers. So this is the biggest #1 operational topic for German companies and remains to be. Despite of that, on the next slide, you can see that German companies are intending to invest significantly over the next couple of years too. So it is a very small number of companies who are not intending to invest at all. So you can see on the bottom, it's just 18% as compared with 15% in the prior year, who are not intending to invest. But it is one above, you see more than 50 millions that is stable, and the layer between 11 and 50 millions slightly decreasing, but you can see that nearly 20% of the companies are intending to invest more than $10 million within the next 3 years. So, and that is also what the companies, the German companies that we are in contact with are telling us. So they do have clear investment plans in place. This brings me then to the specific questions that we asked for this year for the first time. And the first slide that I would like to show to you is related to the election topic. And as I said, we asked that question end of November. So we were asking, what are the policy fields that you are asking the new Biden administration to take care of? So what is on your mind? What is important for you so that it is enabling you to grow your business in the US? And the #1 topic here, very clearly, with 64% of all respondents, is open markets and a trade agreement. And that must be seen also in the context of the duties and customs that have been implemented in 2020. So that is still the case. And a lot of German companies are expecting that steps are being taken to reduce or get rid of those customs and duties. And that no longer unilateral trade agreements are being concluded by the US, but that multilateral trade agreements are concluded again. And specifically that the Trans-Pacific Partnership is reinforced. And surely we can see first steps. So the US President, Joe Biden, and the German Chancellor, Angela Merkel, already had a telephone call and discussed about how to re-emphasize and to build up the friendship between the US and Germany. So I think that this is surely one of the topics that is very important for the German industry too. Apart from that, it's once again availability of work visa for foreign specialists to come over, with nearly half of the companies who are telling us. And then next to that is already, I would say, hard location factors, so such as infrastructure investments. So obviously it seems to be that there's a perception of a necessity for further investments in infrastructure in the US. And there's also the ask for remaining the tax reliefs that have been granted by the Trump administration, and that there are no new increases of taxes in the US. So I think those are clear messages and clear asks to the administration. That then brings me to my last 2 pages, which is related to COVID. So we started with COVID, we will end with COVID, unfortunately. Yeah. So we were asking what are the main topics and the main consequences that we were taking in order to overcome the situation. And once again, I think the picture here is very, very clear. So most of the topics that you can see here that have been raised and where we received the responses are relating to digitalization. So it's about the collaborative technologies. It's also about home working, and home working must be enabled by digital tools. It's about investing in automations in sales channels, as well as in all internal processes. So digitalization is a topic for the whole value chain, starting from procurement. And we heard about a lot of companies who are investing heavily in the supply chains and the digitalization of the supply chains, as well as in the sales channels, because they need to have online channels in place in order to overcome lockdown situations. That is not just true in the US, but actually overall. And in the last slide, we were also asking about changes to the supply chains that German companies are intending to undertake. And here, 38% of the firms told us that they are creating alternate sourcing options. And once again, they're investing into digitalization. So it is no longer just Excel lists or manual work, but it's a lot of digitalization that is implemented. Because it has been realized and experienced that thousands of suppliers cannot be managed without digital tools. However, what I would like to say here is also that companies are not necessarily shifting production bases, but they are building up additional production bases. That is also what we're seeing from a lot of our other service that we are undertaking. It's the same also in China. So German companies are not leaving China as a market. So actually in our survey that we are launching next week on Tuesday in Beijing, 97% of all German companies are telling us that they stay in China, so, and are following a so-called China Plus One strategy, are just building up additional resources and production bases. And the same seems obviously also to be true in the US market. So that brings me actually to the end of my presentation. I hope there were interesting insights for you. All in all, if I would like to summarize it, I would say it is a very optimistic and positive sentiment that we can see from the respondents. And I'm glad to take up any questions. And I hope there are also a number of topics and questions that can be also raised during the panel discussions afterwards. So thank you very much for your interest and glad to answer any questions.
Thank you very much, Andreas. That was very interesting, and I have to say surprising in so many ways. I think maybe we were expecting maybe more of a dim outlook or difference really to last year's results. But the fact that Germany, as you said, is still the #3 investor in the US and the #1 destination for German companies is just always reminding us why we're here and why there's so much interest. And certainly it will be very interesting to see what our panelists now have to say in terms of what is really happening on the ground, right? I know answering a survey can sometimes maybe not always reflect also what's happening on the ground and some of the companies there. So I would suggest that as we have our panel ready to speak and to talk about the survey results, we'll go right into that. And so thank you for joining us, Andreas, from Germany and presenting the report. I am very delighted that we can now welcome our panel and the industry panel, which will be moderated by Bernhard Brinker. And Bernhard is joining us today from Germany, where he is the head of corporate client banking and specialized industries DACH region at JP Morgan. And he was previously with UniCredit and Hypo Vereinsbank, and before that, a partner at McKinsey. And he will be leading the discussion today with Jaime Paris Boisvert, who is the general manager for Siemens Smart Infrastructure and the Eastern Massachusetts and Rhode Island markets. And Jaime has P&L responsibility for leading strategy, sales, and operational activities. And she has been she's been 11 years at Siemens and assumed her current role as the general manager in 2017. And Jamie will be joined by Dr. Roland Wandeler, the Chief Operating Officer at MorphoSys, where he leads all global commercial operations as a member of the management board, with responsibility for commercialization activities worldwide, and has the oversight of the company's US operations. And he also has a unique perspective because he has both led a German business of a US company in Germany. No, the German business of a US company here and the US business of a German company, because he was previously also general manager of Amgen's Germany business in Germany. So quite the interesting perspective. And the panel will be completed by Javeed Buch, Senior Vice President at Windmoeller Hoelscher, who are here located in Rhode Island. And Javeed is an experienced executive working in the machinery industry who joined the company in 2004. And Windmoeller Hoelscher is the world market leader for machine systems for production and processing of flexible packaging. So with that, I will hand it over to Bernhard Brinker for the industry discussion, and we're very curious to hear how the survey results and the outlook reflect what you are seeing and what you're expecting. So thank you and welcome to all of you.
Thank you.
Thanks a lot. Thanks a lot for your kind introduction, Emily, and also from my side, welcome everyone to our panel session here today. And in particular, thanks to Jamie, Javeed, and to Roland for taking the time and being here with us today. It's really great. So let's kick it off. And I would like to first piggyback a little bit on what we heard in the initial presentation from David and also now from the survey, which I think, given the environment we are operating in, paints a fairly rosy and optimistic picture with looking towards year end to 2021. So on the back of that, what is top of mind to you and your companies for this year? Jamie, you want to kick it off?
Sure. I think for Siemens, one of the biggest for all of us as human beings in the world right now is recovering from the pandemic. And so from a corporate perspective, we're really looking at what things that we can bring to our clients to support them in that transition. So we've seen an acceleration of digitalization across multiple industries. And while that's a positive trend, it's one part of this. In addition to that focus on digitalization, whether it's remote access to do things that used to be done in person, or it's the increase in remote working that changes a client's real estate needs. It's also the bigger thing that we see coming as we exit this portion of our new world is the change in process and look at how we plan and measure as we develop new ways to do business. So I think for right now, we're really focused on the things that are different and pushing those forward as it relates to whether it's manufacturing or working in an office space. But the next step is going to be changing those processes, new ways to think about things. I don't anticipate it's going to go back. So as an organization, it's a growth mindset of how quickly can we look at, there's faster business cycles, there's new challenges that are there. So staying curious and resilient and experimenting in new ways to take those next steps, because you don't know what you don't know, but we know it's going to be different. So being prepared for that.
Thank you, Jamie. Javeed, what's your perspective vis-a-vis year end?
It's interesting because this has gone in my head all the time. I was so pleasantly surprised with what Roland said, because we are seeing the same thing. We have been seeing all along, like you watch news and it's like really dim and negative and things are not working. But when we look in our industry, because we are in packaging industry, we have just seen growth and resilience, and like it's two different worlds. I mean, you saw the numbers, how each and every company seems to believe that they have been positive, the profits have been there, the growth has been there, and they also expect the same growth in 2021 and onwards. And we have seen exactly the same thing. We almost never saw any slowdown in any sense, whether it was in investments or activities. There was no slowdown. There was probably a hiccup in March, last year, but that's it. And then it kind of got more and more and more. And I would say the one major change that we have seen is the acceptance of digitalization. Like because in our industry, because we are in a very heavy manufacturing industry, which is kind of a little bit, I would say, archaic in some sense, although the technologies are very heavy, but the people, like, when you package food and stuff, that's old industry. There, the acceptance of new digitalization has become more and more. But it's really, really interesting to see how all the negativity of pandemic and all this has not affected the business as such. I mean, you go into the markets and everything is sold out. We are, our lead times have dramatically 20 to 30% increased, and we have had no slowdown.
Thanks, Javeed. Interesting to hear, Roland, how you and MorphoSys are looking at this from the angle of an industry that is clearly an interesting one these days.
No, absolutely. These are very special times for the overall biotechnology industry, and specifically for MorphoSys. Perhaps I have to give us background that 2020 was a transformational year for us. MorphoSys, founded 29 years ago in the Munich biotech hotspot as one of the leaders in Europe in biotechnology, was for over many years successfully developing medicines for other partners. And in 2020, we brought our first own medicine to the market ourselves here in the US. And so we had a launch in the middle of the pandemic. And if you ask me what's top of mind for 2021 for us, is of course the priority to ensure that we continue a successful launch and bring our innovative cancer medicine to patients. And you touched on it before. This is a time where, obviously, for the biotech industry, we're immensely proud of the contribution that colleagues across companies can have in these very special times. And for us, I would say, for cancer patients, knowing that we have this medicine in our hands, making sure that we can do everything we can from our side to engage healthcare professionals and appropriately support patients is just even more important. And looking at this year, I like the notion of Javeed focusing on digitalization and the curiosity that Jaime talked about, because as we look at 2021, obviously it's about navigating these next months, making sure that we can actually reach and support healthcare professionals and patients. But beyond that, if we believe what David shared with us, that in summer things may be trending up, how do we take the best learnings from what we went through and turn this into innovation that will actually get us to an even better tomorrow? So I think it's a very exciting and a very important year for us.
That's a good lead over to my second question, which is related to the first one. But I would be interested to know under which scenario you and your companies are currently operating when it comes to recovery, when it comes to timing. How do you envisage that to happen? How do you see the path happening back to normal, if I may say so, and whenever it happens, but hopefully it happens soon, when it comes to work from home arrangement, when it comes to meeting clients and business partners, when it comes to the way you operate? So how do you think about that, Javeed?
That's another interesting aspect, because we, especially being kind of, I would say, old school or old economy, we never had any belief in work from home. You would always hear from biotech or software companies that work from home. We never had it. We never, although most of our teams have traveling jobs, but typically anybody who was back in the office were expected to be in office, because the interaction of a office environment was paramount for us. But it is so shocking to me that how everybody geared up. I think it was this pandemic notion as well. As a manager, you have the first reaction is, okay, if everybody is home, will the work will be done? What happens? And we saw exactly the opposite of that. The each and every colleague of ours and each and every person in the company basically worked for how do we do more, actually. And they all had their ideas how to be more effective. And at the end of the day, I would say with our workforce, it has been dramatically more, which is kind of almost like our whole notion of that, you have to be in business, you have to be in office, it has been shattered. That being said, there's still a certain being humans and being social animals, so to say, we miss that still a lot. And it's amazing to me how although with this new video conferencing system, we get most of it done, But when you are in person, I have done only 2 or 3 personal like customer client meetings in all this 1 year. And whenever I did them, then you realize how much you were missing it. What all the things when you sit across with someone, you have a cup of coffee or you eat together, what do you miss? So what it will be interesting for us is what is the right mix? What is the transition? Not that we get too comfortable being home because it's so cool and a click of a button, I can reach 20 people. At the same time, not to overshoot when we are allowed to travel. Everybody runs to, without no reason. So to getting the right mix will be the biggest challenge that we will have, because a lot of our visits in the past were just because we did it that way back in the day, and that's why we were doing it. But now we realize like probably 50% of those are not necessarily needed. So to find the right mix for each person will be the challenge that we have to meet.
Jaime, do you share that perspective?
I do. I think, like my colleagues on the panel here, that we as a global company, we had all the tools to do things remotely. So we had great, everyone was comfortable with using a Zoom or Teams or, so the technology was there. And I think to what Javeed said, we adopted it as the only way we were doing business so quickly. And I think that there was, while we had always had a focus on ownership culture for our staff, what we saw is that they absolutely embodied it during the course of that time. They not only were they as productive and customer focused as they were when they were in the office, in some cases even more so, and we had to work with them to strike a work-life balance. But coming out of it, the sense, again, from a global perspective, is that all employees who have the ability to work and the desire to do that we would look to find a kind of a moderate 2 to 3 day a week, work from home versus work in the office. Now, there are plenty of positions and roles that don't allow for that you physically need to be on a job site or at an office. And in those cases, I think it's going to be more what Javeed said, we're going to have to strike the balance between the different options. But in general, I think we're going to end up with a hybrid approach as we are able to re-enter in all our markets.
Thank you very much. Now, one other aspect we clearly need to touch upon is digitalization. I mean, one thing that has happened for sure, I think it's fair to say over the last year that this trend has accelerated massively. So how has that affected your business or the way you run your business? And perhaps can you share some best practices or some experiences that are worthwhile sharing with the audience? Roland?
Yes, and in all of that, the one thing I want to echo from my colleagues on the panel of what they just before, we were inspired by the way that our teams stepped in and leaned in, and that was definitely a key factor for success and a moment that actually brought us closer together. If you talk about digitalization, as I mentioned before, we brought our first cancer medicine to market, with an accelerated FDA approval. At the end of July, we got the approval and we launched in August in the middle of a pandemic. And as I look back, if I just can cite 2 examples, one is the openness that we saw from the FDA to leverage digital technologies to not stand in the way of innovation, but actually make sure that we can work through everything that is required for this approval, was for us inspiring to see. It required a lot of flexibility from our teams, but we saw equal flexibility and openness from stakeholders here in the US government, which we very much appreciated. And then obviously, the next step for us in terms of digitalization was how do we reach and support healthcare professionals across the country in the middle of a pandemic. And that's, I think, where the combination of new platforms and technologies came in, together with the passion and the resilience and the sense of purpose that our teams have. It's combining virtually the human part with the technology. And as I think forward, I think this pandemic showed to all of us what is possible remotely. And I think it also showed to all of us what we're missing remotely. And as we think about the future, which I agree will be some kind of hybrid model, the question that we ask ourselves, how can we move beyond just it's 2 days here, 2 days there, but to a model where we actually take advantage of the office environment where we're in and our colleagues are in to actually drive innovation and collaboration and sense of belonging, and use remote time effectively for the parts that can be done there. So I think that's where the next level of innovation will come in.
No, thank you. Very interesting. Javeed, what can you share with us on this one?
What we learned actually during this time is what we at least as a company decided to do. Obviously, a lot of things, especially in the early phase of the COVID, was that some of the travel was not possible, especially for our engineers to go out and help our customers. So what we did is at that time, we started a platform a few years back, like IoT platform, which again, from the talk about the software companies and versus our manufacturing companies, it has been a slow start with us. But what happened was what we did was we basically pushed and introduced that platform more and more to the customers, and the acceptance and the eagerness of that and the value of how a remote system can still help you, because typically it's like, oh, I know this machine, I know this, I have to be there and I'll fix it, I'll run it, I know the best. And now when they don't have that, and they're not physically there in their plants and the machines are not working or whatnot, providing that platform to them. And that was basically what our decision what we made is that we will provide to everybody and show them what can be done, because we're all in this phase to understand, yes, you have some heavy duty equipment, you have people in the field, but you also, there are IoT systems, like Industry 4.0 systems that can help you, and to accept them, because we all know what we know. We don't know what we don't know. And since everybody is so busy in normal life, a lot of people don't have the idea or the time to look at what trends can improve and help their businesses. So that was a major change for us, where we were allowed, or we were able to show that to the people, to our customers. Also look into things that can be done remotely. Like James said that there are a lot of things that cannot be done. And for example, for us last year, like training, helping people optimizing production, that was never a remote thing for us. It's like, okay, I'll come in the field, I'll show you how it works, and then you will learn. But now we realize that if there's an eagerness and acceptance from the other side, a lot of that can be done data-driven and remote-driven. So those were the areas where we worked on, and I hope that with the future will actually lead us to kind of have a more open ear to see those things.
I'd love to just add something, if you don't mind.
Yeah, please.
So Javeed, I couldn't agree with you more in regard to the remote, access. We see that as well, particularly at Smart Infrastructure, where we're working with the built environment, with building owners and operators. And the traditional way was, we had the ability to be remote, but the preference was always, particularly in New England, it's come to our buildings. And so there was much greater acceptance, which really fast forwarded things along. And I think the next step for us is in parallel to servicing and optimizing existing systems, it's the building of new, because we're seeing on the construction side of the world where there was always been a focus on efficiency and just-in-time shipping of materials and things that would optimize construction. But for the systems that we have, which are bringing IT and operational technologies together, it's how much of that could you really do offsite? And what we found, and this is, I think, over the course of the last couple of years, and now this is gaining acceptance, is what can we introduce into the construction world that is done, it's pre-built, pre-tested, all ready to go, so that when it gets to the job site, and I know this, Roland, in the pharmaceutical world is a common way to do business, where whole modules are constructed off-site. But in the traditional, say, commercial real estate world, they were slow to adopt. And I think this whole industries are going to be forever changed by adoption of much more efficient and really cost-effective ways. So it's a form of digitalization that, even for the things where I said you can't do it remotely, where you really can, you can change what that on-site experience is like.
Perfect, thanks a lot. Let's switch gears to another topic, and that relates to one of the, I think, important findings of the KPMG survey, and I think it was the same already in the last years, which is the shortage of skilled labor, that this is one of the big impediments or obstacles to further developing the franchise here in the US. My question in that respect, has COVID changed that to a certain degree? Because you could think, on the one hand, there's higher unemployment, so perhaps there is more availability, or is that a different skill set, and or how has this topic developed according to your observations? Jamie, you want to continue with that one?
Sure. I think for us, going into the pandemic, we had so many open requisitions that we were unable to fill. And so, and there was a lot, the unemployment was so low that was really what we saw as the issue. Now where it's a different challenge where unemployment rates are higher, but there are a number of jobs that are unlikely to come back. And so it's reskilling or establishing new industries or new skills to meet our industry's needs that are for those whose jobs are not going to return. So we see our state and local community colleges and technical training centers as an alternative or something to do in addition to four-year degrees, particularly for those who have extensive experience, perhaps in another industry. Siemens, our colleagues as well are invested in lifelong learning. That we're hiring candidates who may have been left out of recruiting pools in the past because of a four-year degree requirement, but where they bring enough life experience that we can expand that, for that group, or things like youth apprentices and use of digital tools to kind of rapidly increase upskill and retain workers. So I think those are going to be the options. It's a different challenge at this point, but it remains a challenge nonetheless and for us.
Javeed, what's your perspective on this one?
For us, I would say we haven't seen a difference. It has been a big issue for us in the past many years, and it has stayed that way. Reason being is, yes, the unemployment increased, but the skill set that we need for our business, and likewise also our customers, there's a certain skill set needed that is still not available in the industry. That's also partly what Jamie kind of pointed out. We do not, and it was one of in the slides, there was like, we don't have the, what's the right word? Like enough technical schools. We have a lot of degree schools and universities and colleges, but there's a lot of work in industry, especially in the manufacturing industry. You need a lot of technical skill set. You don't always need to be an engineer for that, but that lack of that we see in the past, and that hasn't changed. Although because of COVID, a lot of industries and a lot of spaces lost jobs, but those are not necessarily the people who will have the right skill set. And also the taste for it. It's not only the skill set. We can, like Jamie said, that we can always retrain, but the retention is always difficult, because if somebody is more in, like say, hotel industry, but if you want them to go in the manufacturing industry where you're dealing with heavy weights and dust and whatnot, they may want to be there a while for 6 months, and then once the things open up, they will go back. So that we haven't seen a change. That has been also, especially our customers. The biggest challenge is labor force. The biggest challenge, skill set.
And it remains like this, yeah. Yeah. Roland, let's talk about R&D. I think around half of the companies that were surveyed by KPMG responded that they do conduct proper R&D in the US, and of those, roughly another 50% are working together with community colleges and universities. So could you share a little bit, what are your expectations for R&D activities this year in the US, and kind of what external parties you plan to cooperate with in order to foster innovation?
Yes, for us in the biotechnology industry, the US, of course, is a very important market because of its size and its valuation of innovation. But it's also a very important market for us because of the unrivaled level of innovation that you have here, and especially here in the New England, Boston area, the strong talent bench that we have of diverse and well-educated biopharmaceutical talent. Now, there's certainly no lack of competition for that talent, but it was actually the reason for us to open our second hub outside of Munich here in Boston, and we want to continue to invest here in the US. Part of our strategy is to bring more medicines and more indications of our own here to the US. For this, we're opening an R&D hub specifically here in Boston that will allow us to develop these medicines in close collaboration with the leading universities and the leading sites here across the country. So I would absolutely echo that for us, US and R&D is an area of importance and a clear focus for us to leverage that level of innovation that we need to bring the next generation of innovative medicines to the market.
Very interesting. And Jaime, what is your perspective? How is Siemens looking at this?
Yeah, so Siemens has been investing in R&D in the US in particular for over 160 years. And this year looks to be no different. Over the course of the last several decades, we were up to about $1 billion a year in US R&D investment. And based on the goals that we have for growth and the mindset of growth, I anticipate that would continue.
Okay, perfect. So that leads me to my last question that relates to another finding of the KPMG survey, which says, and again already for years, I think that one of the, if not the most important aspect for German multinationals when they look at the US is as one of their most important end markets when they do business. I'm just interested to see to which degree this has been affected by the arrival of the new administration in Washington, and what are your expectations? So, Javeed, do you want to take that first?
Yeah, sure. So, so the last 4 years have been pretty good anyways because of all the tax benefits that our customers had. So US, like you said, that in which in the previous presentations was said, the US is the most important market for us, and being the most tech savvy, most tech demanding, and also most challenging. So we know, especially we talked about earlier, that we don't have the labor deficit is dramatic here, which basically allows us to have the need for more automated systems, more intuitive systems, more simpler systems, so that you don't need the skill set to operate those machinery. So on the hope is that it will stay that way. Earlier, somebody was pointing out that maybe the next tax rules might change, but historically, I would say in the last 10, 12 years, the investment and the being able to write off in the same year has kind of been extended from Bush administration to Obama administration to the Trump administration. It has kind of continued. So we pretty much expect that will stay the same, and the capital investment wouldn't change, and that the demands of US on our company and our industry will stay the same.
Okay. Jaime, do you share that?
I do. Similar to our look at investment in R&D, we've worked with every administration who has served over the course of many, many decades, and we'll continue to work with this administration. We are I think we have our government affair colleagues who work specifically in certain trade and industry associations to make sure our views are known. But for the most part, we expect kind of business as usual, that we would be a good partner and be looking to focus on things that are good for our employees, our customers, and our shareholders.
Okay, Roland, final perspective.
I think as all of us on this call, we have the benefit of knowing Germany, knowing the US, and we know how strong the ties are between our nations. And I was really encouraged to hear from David in the beginning, where he said that this is an era of even closer collaboration between our countries, and so we will be looking forward to that. I think as we manage and navigate the COVID pandemic over these next months, and then think about the recovery, we want to be part of that and support from our side, as we do with every administration, that we can lift our weight here. The one aspect that we continue to advocate from MorphoSys is that innovation is valued, and that patients have access to care. And we hope that this is one of the learnings out of this pandemic, that we all understand how important the research is, the development is, that can lead to these breakthroughs, because at the end of the day, it's innovation that will help us to fight these diseases, new diseases and diseases that have been here, and that's what we'll be continuing to advocate for.
Thank you very much. I was just checking the Q&A mailbox, and the only open question that has remained is actually the question whether there will be a transcript available of this conference, which I'm not in a good position to answer. So I think it's a good time to hand over back to Emily. But before I do that, Jaime, Javeed, Roland, thank you very much. It was terrific to have you. Thank you very much for your insights, and yeah, all the best, and thanks a lot, everyone. Emily, over to you.
Indeed, yes, please. I really enjoyed this panel discussion and hearing all your answers. And of course, it's always good to hear that, there is, positive things going on, and that, you can report, obviously, optimistic outlooks and interesting, especially for MorphoSys last year, very good year, but also for Windmoeller Hoelscher, right? With the packaging, we sometimes forget about that. A lot of times we always look at the biotech industry as the one that, seems to thrive in this time, but, it was really good to get that perspective from Javeed there as well. So quite interesting. And I think, as we always do say, and we did say last year too, and a year ago, while the pandemic, I think it was already mentioned because there were things going on in China, but nobody wasn't anticipating what happened, throughout the world. It's always going to be interesting to see how the future will actually really roll out, and what is going to happen, and hopefully the positive outlook amongst the pandemic will actually be developing. So wishing all of you all the best. I do want to make sure that everybody knows that this event today will be followed next week by another very interesting event. And then we're actually going back to the biotech and the vaccine development, and something that Dietmar Rieck also mentioned, that Germany has been very instrumental in developing vaccines, and BioNTech is obviously already on the market, but there's another company as well that will be is in the run for it. So I'll quickly share that we will be presenting an event on vaccines, and I'll go to the next slide, I hope. Not quite. I'm sorry about this. And no, it's not popping up. But please do check our website. We have on Thursday, February 4th, an event on vaccine development with CureVac, with a representative executive from CureVac, as well as from Gavi, the Vaccine Alliance, as well as a professor from the Gladstone Institute in San Francisco and UC San Francisco, and also from Millipore Sigma, which is the life science business of Merck. So please do check that on our website. Registration is open. We'd love to see you for another webinar. And with that, again, thank you to all our panelists, to KPMG Germany for the results of the survey, for JP Morgan for co-organizing this event here with us, and David Kelly for the interest in economic outlook. And I hope to see many of you who have been joining in as participants on other events. Please do reach out to us if you have ideas for events, if you would like to see speakers. We're always delighted to see you and share what German companies here in the US, and especially in the New England areas, are doing. So with that, and very much on time, I will leave you to the rest of the day. Please do get back to us with questions and ideas, and have a very good weekend. Thank you very much.